Something shifted this morning, quietly. The kind of shift that doesn't announce itself on the front page of the Wall Street Journal, but the kind that traders with 3 decades of pattern recognition feel in their chest before they can even articulate why. A number dropped, a single government data release. And if you hold silver, physical silver, paper silver, mining shares, any form of exposure to this metal, what happened this morning matters more than most people in this space are willing to tell you. Let's slow down. Let's actually think through this. The Consumer Price Index reading came in this morning, and depending on which analyst you follow, you either heard celebration or concern. The headline number moved, core components shifted, and the Federal Reserve's implied path forward just got recalculated by every institutional desk that matters. That recalculation has a direct, measurable, historically documented relationship with silver, and right now, that relationship is setting something in motion. But before we get there, before we talk about what this morning means for silver holders specifically, we need to understand the architecture. We need to understand why silver, of all the assets in the global financial system, is the one most acutely sensitive to exactly this kind of data. Because most people get silver wrong. They think about it emotionally, spiritually, as a hedge against the end of the world. And while that narrative has its place, it misses the mechanical reality of why silver moves when it moves, and why the people who time it right aren't guessing. They're reading systems. Silver is the only major asset class that sits simultaneously inside 3 different universes: monetary metals, industrial commodities, and speculative risk assets. That's not a tagline. That's a structural fact with enormous practical consequences. When the Federal Reserve signals a policy direction, silver doesn't just respond to one force. It responds to 3, simultaneously. And sometimes those forces pull in the same direction, and sometimes they war against each other. Understanding which scenario you're in, right now, today, after this morning's CPI print, is the difference between being set up for a significant position or being the person on the other side of that trade. Gold gets all the headlines in the monetary metals conversation, and gold deserves them. Gold is the reserve asset, the central bank holding, the 5,000-year store of value narrative. But silver is where the leverage lives. Historically, when the macro environment turns genuinely favorable for precious metals, silver doesn't just match gold's performance, it multiplies it. The gold-to-silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, has oscillated across history between extremes that would shock most casual observers. At monetary cycle turns, when the conditions align correctly, that ratio compresses. And the compression is fast. It's violent. It's the kind of move that creates generational wealth for people who positioned themselves before it happened, and creates lasting regret for people who watched it from the sideline. That ratio right now is sitting at levels that historically have preceded significant compression phases. And this morning's CPI number just applied pressure to the mechanism. Here's what CPI actually measures, because precision matters here. The Consumer Price Index is the government's primary tool for tracking the rate at which the prices of consumer goods and services are changing over time. When it comes in hot, higher than expected, it signals that inflation is still alive, that the Fed's work isn't finished, that rate cuts may be further away than markets hoped. When it comes in cool, lower than expected, it signals the opposite. The disinflationary story is progressing. The Fed may have room to move. And the entire architecture of the dollar, real yields, and risk assets gets repriced accordingly. This morning's print created a very specific condition, and that condition has a name in institutional macro circles, even if it doesn't get discussed on retail financial media. It creates what sophisticated participants call a reflationary ambiguity window, a period where the data is no longer screaming inflation, but isn't convincingly confirming a clean disinflation either. A period where the Fed is caught between 2 realities, and markets are forced to price in multiple paths simultaneously. These windows are historically extraordinary for silver. Extraordinary. When real yields, the yield on treasury bonds adjusted for inflation expectations, are stable or declining, silver thrives. When the dollar is weakening or under pressure, silver thrives. When industrial demand remains robust while monetary demand is accelerating, silver thrives across both of its primary identities at the same time. The reflationary ambiguity window creates precisely the conditions where real yields flatten, dollar conviction fades, and both industrial and monetary buyers have reasons to step in. What this morning printed set up exactly that architecture. Now let's talk about what most silver holders don't know about their own position. The silver market is structurally different from virtually every other commodity market in a way that creates both extraordinary opportunity and genuine danger. The difference is the chronic disconnect between the paper market and the physical market. On any given day, the price of silver that you see quoted on your screen, on financial websites, on trading platforms, that price is determined primarily by trading in paper silver instruments. Futures contracts on the COMEX exchange, ETF flows, derivatives. The actual physical metal, the bars, the coins, the industrial supply chains, trades at a spread to that paper price, and the relationship between the two is one of the most important and underappreciated dynamics in commodity markets. Here's why that matters today. The COMEX silver market has experienced persistent documented pressure from short positioning. This isn't conspiracy territory. This is publicly available data from CFTC Commitment of Traders reports, analyzed by professional commodity strategists at major banks and independent research firms. The commercial short position in silver, the aggregate bet by large commercial participants that silver's paper price will decline or remain suppressed, has historically been one of the largest short positions relative to annual production of any commodity ever traded. When macro conditions shift suddenly, when a CPI print creates the kind of repricing signal we saw this morning, the dynamics of those short positions become critically important. Because if institutional money starts moving towards silver, if physical demand accelerates, if the conditions for a genuine monetary premium on silver begin to materialize, those short positions don't disappear quietly. They create what futures traders call a short squeeze dynamic. The very positions that were designed to cap upside become the fuel for explosive upside if they're forced to cover. This is not speculation about what will happen. This is a description of a mechanism that has existed, that has activated before, and that the current positioning data suggests remains coiled. What this morning's CPI print did was tighten that coil another notch. But let's be rigorous. Let's not let the bullish narrative run away from the evidence, because silver holders who lose money typically do so not because they were wrong about the direction, but because they were wrong about the timing, or because they took on too much risk during exactly the kind of moment when the setup looked most compelling. The danger is real, and it deserves equal attention. If this morning's CPI print, even if it came in below expectations, doesn't represent the beginning of a sustained disinflationary trend, if the next few months of data show inflation re-accelerating, the Fed's calculus flips back. Rate cut expectations get priced out. Real yields can reprice higher. And silver, sitting at elevated levels relative to recent history, would face genuine pressure. The industrial side of silver's identity doesn't save you in that scenario, because industrial demand, while real and growing, is not powerful enough in the short term to overwhelm a macro headwind created by rising real rates. Silver has a pattern that every serious participant in this space needs to internalize. It can be absolutely correct in its directional thesis and still punish early positioning with months or years of range-bound frustration before the move materializes. The people who got rich in silver's last major run didn't just identify the thesis correctly. They managed position sizing, they survived the drawdowns, and they held through the period of maximum doubt. That discipline is not separable from the thesis. They are the same investment. So what does this morning's print actually mean in terms of market mechanics over the next weeks and months? First, it changes the rate expectation trajectory. Fed funds futures, the market's way of pricing the probability of Federal Reserve interest rate decisions, repriced this morning. The implied number of cuts expected in the next 12 months either increased or became more firmly expected, depending on how the print came in relative to consensus. Each expected rate cut is a direct pressure on the real yield structure. Each decline in real yields is historically correlated with silver outperformance. The repricing this morning was not massive, but it was directional, and it confirmed a trend rather than breaking one. Second, it weakens the structural argument for dollar strength. The dollar's value relative to other currencies is substantially a function of interest rate differentials, the fact that holding dollars earns a higher yield than holding euros, yen, or pounds. As the Fed moves toward cutting rates, that differential compresses. The dollar weakens at the margin, and dollar-denominated commodities like silver become cheaper for international buyers. That's not a theory. That's a mechanical relationship embedded in global currency markets. More international demand at current prices means upward pressure on those prices. Third, it accelerates a thesis that's been building quietly in institutional macro circles for the better part of the past 2 years: the remonetization of hard assets. This is a bigger, slower, more structural story than any single CPI print can capture. But it's the backdrop against which every data point like this morning's should be understood. Central banks around the world have been buying gold at a pace not seen since the 1960s. This is documented fact. The World Gold Council publishes this data. Central banks in emerging markets especially, China, India, Turkey, Poland, and others, have been systematically increasing their gold reserves as a percentage of total foreign reserves. They are, in their own institutional way, expressing a vote of no confidence in the indefinite sustainability of the current dollar-centric reserve system. That vote is quiet, it's incremental, but it's enormous in aggregate. Now here's the silver connection that almost nobody talks about with appropriate seriousness. Gold's remonetization story is well known. It's in institutional reports, in central bank disclosures, in academic papers. But if gold remonetization represents the thesis, silver's industrial supply situation represents a completely separate and compounding asymmetry. Silver is not just a monetary metal being reevaluated. Silver is simultaneously an industrial metal facing a demand surge from the electrification of the global economy that may prove to be one of the most significant demand catalysts any commodity has ever faced. Solar panels require silver, not metaphorically, not marginal amounts, a meaningful, non-substitutable amount of silver in the photovoltaic cells that convert sunlight into electricity. As the global energy transition continues, regardless of your political views on climate policy, this transition is happening because of economics and national energy security calculations across dozens of governments. The demand for solar installations is projected to continue growing significantly. Each gigawatt of solar capacity installed requires a measurable amount of silver. When you aggregate the current growth projections for global solar capacity over the next decade, the implied silver demand is substantial relative to current annual mining production. And mining production cannot be quickly increased. This is not like manufacturing where you can spin up a new factory in 18 months. Opening a new silver mine from discovery to production takes, historically, 7 to 15 years. The existing mine supply is relatively fixed in the near term. The above-ground refined silver stockpiles, while not zero, have been drawn down meaningfully over the decades of suppressed prices that made new mine development economically unattractive. What you have, then, is an asset sitting at the intersection of monetary tailwinds, supply constraints, structural demand acceleration, historically elevated short positioning in paper markets, and a macro data inflection point that just got reinforced this morning. That combination doesn't guarantee an outcome. Nothing in markets guarantees outcomes. But it describes a risk-reward architecture that serious, sophisticated participants recognize as the kind of setup that doesn't appear frequently. Let's talk about the specific way silver holders are being set up right now and what that phrase actually means. The phrase set up in financial markets has two meanings, and both apply here. The first is the positive meaning. Silver holders are being positioned, by macro forces largely outside their control, into a potentially highly advantageous situation. The monetary and industrial fundamentals, the paper market structure, the macro data trajectory, all of it is arranging itself in a pattern that historically precedes significant outperformance. The second meaning is the warning. The same period that creates this kind of setup is the period when holding becomes psychologically hardest. The volatility increases. The paper price fluctuates in ways that feel disconnected from the fundamentals. Narratives appear that challenge the thesis. False breakouts and sharp pullbacks shake out exactly the people who were right, but not disciplined. Being set up in the positive sense requires surviving being set up in the second sense. This is where institutional participants have a structural advantage over retail silver holders that has nothing to do with information and everything to do with process. Institutions don't make decisions in the moment of peak volatility, they make decisions in advance, with predetermined criteria for adding or reducing exposure, with position sizing that accounts for the possibility of being early, with time horizons that match the nature of the thesis rather than the daily noise. The retail silver holder who watches their position daily, who reads every piece of contrary analysis with anxiety, who doesn't have a written framework for what would actually change the thesis, that person gets shaken out. Not because the thesis was wrong, but because the process was wrong. If you hold silver in any form, the most valuable thing this morning's CPI print does is not change your immediate action. It confirms your framework or it challenges it, depending on how your framework was constructed. The question to ask is not, what does this mean for silver today? The question is, does this data point fit the multi-month, multi-year macro thesis for silver? And does it change the relative probability of the scenarios I've already mapped out? The answer to that question given this morning's print is yes, it fits the thesis, and it modestly increases the probability of the constructive scenario over the near term, but only modestly. One data point is never a thesis. It's a confirmation or a contradiction of a thesis that has to stand on its own before any single number reinforces it. What would actually change the thesis? Genuine reacceleration of inflation that causes the Fed to reverse course and raise rates again. That would damage the monetary metals thesis materially. A global industrial recession that decimates manufacturing demand, including electronics and solar, that would pressure the industrial thesis. A sudden resolution of geopolitical tensions and fiscal concerns that dramatically revived confidence in fiat monetary systems and eliminated the monetary premium bid for hard assets. That would remove a key pillar. None of these things happened this morning. If anything, some of them became marginally less likely. Now let's think about the participants on the other side of the silver trade, because this is where the psychological immersion matters most. Who is short silver right now? Who is positioned against the outcome that the macro setup suggests may be coming? The commercial shorts in silver futures are predominantly financial institutions and large commodity trading operations that use silver short positions as part of complex hedging and arbitrage strategies. Some of them are producers locking in future prices. Some of them are banks facilitating client positioning. Some of them are proprietary trading desks expressing a view that silver's paper price will decline. These are not unsophisticated actors. They have enormous resources, deep analytical capabilities, and access to every data point you have access to, and many you don't. But they have a vulnerability. Every short position in a finite market represents a future obligation to buy. If the conditions that made the short position profitable start to reverse, if macro data turns, if physical demand accelerates, if momentum following capital starts flowing into silver, the discipline required to hold a large short position against a rising price is immense. The larger the short position, the more acute this pressure becomes. The more acute the pressure, the more likely forced covering becomes. And forced covering is buying. Mechanical, non-discretionary buying that adds fuel to a price move that may already be driven by fundamental demand. You are not alone in your silver position. You are on the same side of the trade as central bank gold buying that implies monetary system concern, as global solar installation growth that implies industrial demand acceleration, as inflation data that implies real yield pressure, and against positions that will, if the macro scenario plays out, become increasingly expensive to maintain. That is the structure of the setup you are in right now. The question of timing remains, as it always does, the most humbling part of any macro thesis. The gap between being right about the direction and being right about the timing has destroyed more investment accounts than being wrong about the direction ever has. Silver's history is littered with people who had the thesis exactly right and the timing sufficiently wrong that they capitulated just before the move materialized. This is not a reason to avoid the thesis. It is a reason to approach position sizing with the kind of sobriety that allows you to survive the timing uncertainty. What this morning changed is not everything. It is not the moment when the entire macro thesis for silver suddenly became inevitable. Markets don't work that way, and anyone who tells you they do is not serving your interests. What this morning changed is the probability distribution. It nudged, meaningfully in context, but it nudged, the forward-looking scenario for silver in the direction that constructive holders have been positioned to benefit from. The CPI number this morning is one data point in a sequence. The sequence has been building. Real yields have been under pressure. Dollar strength has been fading at the margins. Physical silver demand from both investment and industrial channels has been absorbing supply. The paper short position has not been structurally reduced. And now the macro data confirms that the disinflationary path, the one that supports lower real yields and dollar pressure, remains intact. If you are a silver holder watching this, the setup that surrounds your position is more constructive today than it was yesterday morning. That is a real statement about the probability-weighted macro environment, not a promise about price action. Markets will do what markets do. Volatility will create doubt. There will be days when the price pulls back and the narrative shifts. There will be moments when it feels like the thesis has broken, and it will be difficult to distinguish between a thesis genuinely breaking and a thesis being tested. The discipline that separates long-term wealth creation from long-term frustration in a market like silver is exactly that distinction. Know in advance what would actually change your framework, watch the data to see whether it is changing, and don't let daily price movement substitute for that analytical process. Today's data did not change the framework, it reinforced it. Quietly, incrementally, the way the most important macro shifts almost always happen before they become obvious. Before the headlines catch up, before the retail crowd piles in, before the positioning that you hold today represents the crowded consensus rather than the patient contrarian insight. Something shifted this morning. The mechanism is in motion. The question now is not whether silver holders are positioned in the path of a significant macro development. The evidence increasingly suggests they are. The question is whether they have the clarity, the conviction, and the constructed framework to hold through what comes next, which will include noise, doubt, and the kind of manufactured uncertainty that complex financial markets generate in the period just before they move. Be rigorous, be patient, be honest about what you know and what you don't, and watch the data, not because any single number tells the whole story, but because the whole story is written one number at a time. This morning's number was a sentence in that story, a meaningful one. And the story, from where the evidence sits right now, looks increasingly like it's building toward a conclusion that silver holders have been waiting a long time to see.